To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
So to quickly summarize whatever we have learned about translation, there could be multiple scenarios. Okay, so say we are talking about a reporting entity based out of India and has a functional currency USD. Okay, so this is an example where the functional currency is USD, right? Then the presentation currency is INR. Presentation currency is INR and there are no foreign operations. Okay, so whenever there is a foreign currency transaction, that is a transaction other than in USD, all of that will have to be converted into and recorded here. So accounting will be done in USD only, and you will convert these USD transactions to INR for the purpose of presentation. And for that, what is the principle that we have understood? As far as assets and liabilities are concerned, you will take the closing rate. Okay, then for P&L items, you will take the average rate or transaction date rate. Okay, so you will take both of these. So for converting the assets and liabilities, you take the closing rate. For P&L items, you will take either the transaction dates rate or the average rate, and the resulting difference will be accumulated in OCI. Okay, now that is what you do from functional to presentation currency. Now what if there is a foreign currency transaction? Even if there is a foreign currency transaction, your recording will happen in USD only. You will record it in USD. You will convert those transaction into USD transaction considering the date of transaction and account for it in USD. And then when it comes to foreign currency transaction, okay, say for example there is a foreign currency transaction in GBP, you will record them in USD. So this is where the accounting will happen. Okay, and at the end of the period, if they are monetary, you will restate and resulting difference will be taken to P&L. Okay, if they are non-monetary, then if the non-monetary items are carried at historical rate, you will consider the historical exchange rate. If they are carried at fair value, then you will consider exchange rate on date of fair value. Okay, so here, so if they are carried at historical values, you will take the historical rate. If they are carried at fair value, you will take the date of fair valuation to determine the rate. Okay, and monetary items difference will go to P&L. For non-monetary items, you will check where will the P&L of those non-monetary items be taken to. If they will be taken to P&L, you will take them to P&L. If they are taken to OCI, you will take them to OCI. Okay, now one aspect where a lot of students get confused when it comes to foreign currency transactions is specifically with respect to translation. So there can be a foreign operation, I am writing it as foreign operation, then you have functional currency of the entity and you have presentation currency of the entity. Okay, now say for example this foreign operation has a USD as functional currency. This Indian entity, this is the entity. Okay, this entity also has functional as USD and presentation as USD. Then there is no question of translation. You can just take up this, add it here and bring it here. There is no question of conversion also. Let us say this is USD, functional here is INR and presentation here is INR. Then what do we do? From USD to INR, we do a translation. From USD to INR, we do a translation, and from INR to INR, you will just do a simple addition. Okay, say this is GBP, this is USD, this is INR. Okay, so the foreign operation has a functional currency GBP, the entity has a functional currency USD and a presentation currency INR. So here you will follow a two-step approach to convert or translate the financial statements. From this to this, and from USD to INR. The principle of accumulating the differences and all of that would remain the same that we have understood. Generally, such complex things are not tested in the examination. Okay, in real life, you may come across a situation where the functional currency is different and presentation is different, but very few circumstances. Okay, you will not find too many of such kind of complexities. What you generally would see is something like a USD to INR to INR, something like this. Okay, one foreign currency and to your domestic currencies, right? So we have seen how to translate a financial statement. What do we do with the difference? The difference is accumulated in something called as foreign currency translation reserve, right? Now, if you relate this to what you have learned in AS11, AS11 talked about something called as integral foreign operation and non-integral foreign operation, and based on this distinction, you had to translate the items. Now here, there is no such distinction at all. It is simply about, is the functional currency of the foreign operation different from our functional currency? If that is the case, you have to do the translation. Whatever is left over, that will be accumulated in the foreign currency translation reserve, right? So that is about translation. Now when we talk about translation, we also need to understand translation of subsidiaries financial statements. What do we do with the non-controlling interest? And we also need to understand a term called NIFO. This is not non-integral foreign operation. This is net investment in foreign operation. We need to understand what is the net investment in foreign operation, and we need to understand what will be the impact of translation of financial statements. How do we handle this NIFO, and what will be the impact of changes in NIFO? All of those things is what we need to understand. Let's now move on to another aspect of the standard, which is very critical, very important, not only from exam point of view, but also from your career point of view. In the future, if you are working with MNCs, you will definitely come across a lot of foreign operations, and you have to incorporate the foreign operations financials into the entities financials. Now you might be wondering, sir, we have already seen the process of conversion or translation of financial statements of a foreign operation to the entity's currency. That is one aspect. But then there is one more aspect which I had on purpose not explained to you earlier, because you need to be comfortable with the standard before we get into complicated topics. And that aspect is net investment in foreign operation. So we are talking about net investment in a foreign operation. Now what is a net investment in foreign operation? To put it very simply, say for example, you have a company in India, based out of India, let's say it is Reliance. Okay, and the functional currency is INR, and Reliance Industries has a branch outside India. It has a branch outside India. It can be subsidiary or anything. It has a foreign operation. Okay, so let us say it has a branch, Reliance US branch, and the functional currency of that branch is USD. Okay, so you have INR and you have USD, right? Now to start the branch, Reliance Industries invested, say for example, 80,000 rupees. I can add crores also. I am just using a simple example to make you understand the concept. Okay, so Reliance Industries invested how much? 80,000 INR into the US company. Now what we will do is we will prepare the balance sheet, or we will see the presentation in balance sheet in both Reliance Industries financial statements and the branch financial statements, and see what happens after 1 year. Okay, so in the Reliance Industries financial statements, I will say RIL here, the functional currency is INR, and here you have Reliance US, functional currency is USD. Okay, now in the books of RIL, on the asset side, and don't worry about the format and all, you just see the balance sheet impact. What will you show? You will show investment in Reliance US. How much? You will say 80,000 INR. Okay, because you have given INR, you will show 80,000 INR. Now come to Reliance US. In the Reliance US balance sheet, you will see something on the equity side, something on the equity and liability side. Okay, you will say owner's equity or owner's capital or parent's capital, whatever you say, you can say RIL capital. How much? Not 80,000 USD, right? You have to convert the foreign currency amount into the functional currency. At what rate will you convert? you will convert using the exchange rate on the date of transaction, and assume for a moment when the exchange rate is 80. Exchange rate is 80. So 80,000 divided by 80, you get 1,000. Okay, this is the financial statement. Now, what also happens is Reliance Industries sells goods to the Reliance US branch. Okay, Reliance US also purchases from outside. All of the transactions happen. Now, in the course of sale and purchase, Reliance Industries gives credit to Reliance US. So, say for example, at the end of the reporting period, the amount outstanding from Reliance US is say 20,000. So, Reliance US 20,000. Okay, at the end of the period. Now, at the end of the period, you will also have your accounts payable. Okay, now this accounts payable, whatever you have, that accounts payable is a foreign currency monetary item, correct? Because 20,000 is what you need to pay, even they will say, okay, 20,000 is the amount that is to be paid, so it is a monetary item. What do you do with this monetary item? You will restate the monetary item at the end of the reporting period. So, say when the transaction happened, for example, the rate was 80. When the transaction happened, the rate was 80. Now, because of lot of changes, this and that, the value at the end of the reporting period is 100. So, here accounts payable is 20,000 divided by 100, which is 200. Accounts payable is 200. But initially it was recognized as 20,000 divided by 80, that is 250. So, initially the transaction was recognized as 250, but now at the year end, the transaction is being recognized at 200, or the accounts payable is being measured at 200. Is there a gain or a loss? There is a gain. So, there is a gain on remeasurement of a foreign currency monetary item, which is a liability. Now, this gain, what do we do with this gain? Think of it. As far as Ind AS 21 is concerned, any gain arising out at the time of remeasurement of foreign currency item, any exchange difference that arises, that is taken to P&L. So, the branch will say P&L 50. P&L 50. Okay. Whether these goods are sold or not, we are not getting into that, but P&L it is 50. Right. Now, whenever this transaction is settled in the future, in the next coming months, 2 months, 3 months time, this gain will actually be realized by the branch. That is the first aspect. Okay. Now, in this case, what happens? There is a sale transaction. Okay, there is actually a sale transaction. This branch will sell these goods outside. Okay, on that they will make some profit. All of those things would happen, and this is a part of your normal trading transaction, and which has created monetary asset and a monetary liability. But think of a case where there is also a loan given. A loan is given 20,000, and this loan of 20,000 is not repayable. So then how is it a loan? Is it not an equity investment? I am coming to that. The structure of the loan is that you will have to repay the loan only at the time of closure of the branch. So in effect, this loan is not a loan, but it is like an equity. Or the company has said that you don't need to repay the loan till the time you achieve some level of profitability. So even in that case, the repayment of the loan is not very clear as to when will the repayment happen. But is the loan a monetary item? In the Reliance books or in the books of the branch, is loan a monetary item? Of course, yes, you know the amount to be repaid. Amount to be repaid is 20,000. So, this is a monetary item. Now, when you come to the equity and liability here, let us say you also have a loan, and this loan is 20,000, recorded initially at 80, but at the end of the period it is to be recorded at 100 because it is a monetary item. So, you will record the loan at 200. On this also you will have exchange gain. Right. On this also you will have exchange gain on remeasurement, which will be equal to 50. Now, what should I do with this 50? This 50 of gain should also be recognized in the P&L of the branch. So, what the branch will do, this 50 will also be recognized in P&L. Okay, this 50 will also be recognized in P&L. Now, whatever I have told you so far in this example, you already know. This is just a revision. But the thing that I am telling you now is the most important part. What is that? Now here what the standard says is, these kind of loan which are given to the foreign operation, or there could be any other liability or any other asset which are arising due to the transaction between the entity and the foreign operation, if that is not repayable immediately, or if that is not being settled very soon, if they are long term items and generally repayment is not expected or not decided, then though they are monetary items, the gain or loss arising on those monetary items, when you incorporate the foreign operation in the reporting entity financials, don't take that to P&L. What do I mean by that? Now what do I mean by that? What I mean is, if there is some item like this, account payable and account receivable, which are in the normal course of trading and which will be settled frequently, for such transactions, if there is any P&L, then when you incorporate the foreign operation into the reporting entity, the gain can be taken to P&L. That is the first aspect. The second thing what the standard says is, these kind of loan which are given, which are ordinarily not repayable pretty soon, they have a long term maturity, then in that case, this gain on remeasurement, because the parent entity is not expecting any repayment, then in that case, the gain or loss, whatever it arises on such transactions or such monetary items, should not be taken to P&L when you prepare the consolidated statements or when you incorporate the foreign operation into the reporting entity's financial statements. So the summary of the discussion is, the branch will credit this to P&L and this also to P&L. Means the branch in its standalone financial statements will take the gain or loss on translation of monetary items with its reporting entity. Those will be taken to P&L. Similarly, if there are some foreign currency transactions here, okay, if let's say instead of giving INR, they invested in USD, for example, instead of giving in INR the loan, they have given the loan in USD. In the standalone financial statement, that is the financial statement without the foreign operation, in that the entity will take those gain or loss to the P&L. But when you incorporate this foreign operation, for example, if it's a parent and subsidiary company and you incorporate the subsidiary in the consolidated financial statement, or when you are preparing the standalone financial statement along with the financial statement of foreign operation, then in that case, the loss or gain of these kind of items will not be taken to P&L, they will be taken to OCI. So that is one thing you have to understand. In standalone financial statements, give the treatment that you normally give. But in the consolidated financial statements, such items, these kind of items what I told you, these will not be taken to the P&L, these will be taken to OCI. You might be wondering, sir, how will we know which items to be taken, which items not to be taken? That again has to be decided on the facts and circumstances of the case. Now what the standard says is, these kind of items, we talked about exchange, we talked about loan which is not repayable for a long period of time. These kind of items are in substance net investment in foreign operation. So when we talk about net investment in foreign operation, one thing that is included is the net assets of the foreign operation. So the standard says net investment in a foreign operation is the amount of reporting entity's interest in the net assets of that operation. So whatever is the net asset, that is this equity part, right, which is 1000, this is net investment in foreign operation. Okay. Sir, what about this accounts payable? Accounts payable is not a part of net assets. How do you decide net asset? Net assets is equal to total assets minus outside liabilities, right? That is what is the net asset. So this equity part plus profit and all whatever comes up, that is a part of NIFO, that is net investment in foreign operation. Any P&L balance that gets added, that is also a part of NIFO, that is net investment in foreign operation. Okay. Say for example, the branch earned a profit of 500. So 1000 plus 500, 1500. That 1500 is the net investment in foreign operation, and that 500 is the profit element. Okay. That is what is a net investment in foreign operation. So net investment in a foreign operation is the amount of the reporting entity's interest in the net assets of that operation. And what the standard also says is, if there are items like this, which are though a monetary item, but in substance they are like net investment in foreign operation. Now why am I saying that it is in substance something like a net investment in foreign operation? Because I have given a loan. Reliance has given a loan to its branch saying that you repay it only when you close the branch. then it is indirectly like an investment only, right? See, one thing is making an investment which will be recovered at the end of the, at the time of closure of the branch. And if I am giving a loan, which I am saying is perpetual loan, or you repay it after some point of time, like when you achieve some level of profitability, then in that case, that also takes the nature of an investment. So, such items are also considered as net investment in foreign operation. So, whenever you see of net investment in foreign operation, one is net assets, then you have monetary items for which settlement is not expected. Settlement is not expected meaning there is no decision as to when the settlement will happen. But in place of this, if the parent company gives a 10-year loan, then the 10-year loan is not a net investment in foreign operation. Items which should not be repaid, items for which the repayment is not yet decided, or the management thinks that okay, we will see at a later point in time. Such kind of items will in substance form a part of net investment in foreign operation. Now, whatever we have discussed so far with regards to monetary items, that is either receivable or payable, what the standard says is, an entity may have a monetary item that is receivable from or payable to a foreign operation. So, either there is a receivable or there is a payable. Receivable could be something like a loan, there can be trade receivables. Then as far as payable is concerned, there could be, in the reporting entity, there may be some amount which is payable, or the entity itself may have borrowed some amount from the foreign operation. Any scenario is possible. What the standard says is, if an item which is a monetary item that is receivable or payable to a foreign operation for which settlement is neither planned, that means you have not planned the settlement, nor likely to occur in the foreseeable future. Okay, that is in substance a part of the entity's net investment in that foreign operation. So, whenever an entity sees, okay, what is my net investment in that foreign operation? First thing is obviously the net assets of that foreign operation. That is anyways the net investment in foreign operation, and apart from that, these items which are monetary items for which settlement has not yet been planned, even that is considered to be a part of the net investment in foreign operation. Now, the reason we need to understand this is because the moment I say that some item is an item of net investment in foreign operation, then the treatment at the time of consolidation or incorporation of the foreign operation trial balance or the financial statements, it will be different. Now, what I mean is, if it is a monetary item like a trade receivable or trade payable, that will be settled in the course of transactions for which the settlement is also planned, then for such items there is no separate treatment. But the moment I say that something is a part of net investment in foreign operation, then at the time of consolidation, any exchange difference that arises, or at the time of incorporation of financial statements, any exchange difference that arises, that has to be accumulated in the OCI. That is why we need to understand which monetary items form a part of net investment in foreign operation. So, when there is a monetary item which is a part of NFIO, the monetary item is a part of NFIO, the way you should deal with is in the standalone financial statements. Standalone financial statements of whom? Standalone financial statements of the reporting entity or of the foreign operation. When you are preparing the standalone financial statements, then at that point of time, the treatment will be like monetary item. Meaning to say, normally how you treat a monetary item, you will treat them also accordingly. You will recognize the gain or loss in the P&L. That is when you are preparing standalone financial statement. But if you are preparing a financial statement of the reporting entity plus the foreign operation, then in that case, monetary item which are a part of, in substance, NFIO, exchange gain or loss will be accumulated in OCI. Now, in essence what this means is, to the extent an item represents the net investment in foreign operation, if there is an exchange gain or exchange loss at the time of translation or at the time of conversion, then in that case such exchange gain or loss will be accumulated in other comprehensive income. You will not take it to P&L. But This is done only when you are preparing the financial statement of the reporting entity plus the foreign operation. Something like maybe a consolidated financial statement, or you are incorporating the branch balances. In that case, if the exchange gain or loss pertains to the NFIO, the monetary items which are a part of NFIO, then in that case the exchange gain or loss will be accumulated in OCI as foreign currency translation reserve, and that will be transferred to P&L only at the time of disposal of that foreign operation. So friends, we have understood about monetary items being a part of NIFO, they are not being a part of NIFO. We had multiple discussions around that. Let us quickly summarize whatever we have learned so that we retain them for our exam purpose, and also when you have to implement these in your real life, it becomes easier. Okay. So, say there is an Indian entity which is the reporting entity which has the functional currency INR. There is a foreign operation which has a functional currency USD. Okay. Now, there are some monetary items. Monetary items which is either receivable from the foreign operation or which is payable to the foreign operation. Okay. Now, these monetary items may be a part of NIFO, may not be a part of NIFO. If they are not a part of NIFO, then no need to break your head. Whatever is the gain or loss, you will calculate those gain or loss, take them to the independent P&L, and after that there is no further treatment. But let us say there are monetary items, and these monetary items are denominated in either USD or INR, and they are part of NIFO. Now, when they are a part of NIFO, what happens is, in reporting entity, there will be a gain or loss. In foreign operation, there can be a gain or loss. Now, say for example, the transaction is designated in USD. Now, in that case, think and tell me, which entity will have an exchange difference gain or loss? The transaction is designated in USD. So, if it is designated in USD, will it have a gain or loss impact in the reporting entity's financials or in the foreign operations financials? See, if it is designated in USD, then in the foreign operation, there will not be any translation or there will not be any restatement. So, no question of gain or loss. Whatever is the gain or loss will happen in the Indian entity. So, here gain or loss will be booked. Okay, if it is a transaction in USD, the reporting entity will book gain or loss. If there is a transaction in INR, then the foreign operation will book gain or loss. Sir, what if the transaction is in GBP? Then both the entities will book the gain or loss. Okay. Now, that is when it is not a part of NIFO. Now, this gain or loss which is booked, this is booked in the standalone P&L. So, I will just say gain or loss in P&L. Okay. And here also it is gain or loss in P&L. Right. Now, in the standalone financials, there is no complexity, there is no problem. And as I told you, if there is a third currency, then both of them will book the gain or loss. But while consolidating, while preparing a combined financial statement, what the standard says is, the gain or loss on monetary items which are a part of net investment in foreign operation, you will not take that in P&L. In combined financials, that is reporting plus foreign operation, you will take it to OCI. So, basically whatever is the P&L impact given in the individual financial statements, you will consolidate that into the OCI and you will retain it till the time you dispose of the foreign operation. Now, based on the discussion we had, let us have a look at a question. The functional currency of parent P is Euro. Okay, please be careful in noting down what is the functional currency and what is the reporting currency, etc. Because we are always in a default mode saying that the functional currency will be INR, the foreign currency is USD, nothing like that. Okay, you have to look at the question and mark it very, very carefully. So, the functional currency here is Euro, while the functional currency of its subsidiary S is USD. So, parent company has Euro, subsidiary company has USD. P sells inventory to S, parent sells to subsidiary, and a transaction for the same was made for USD 300 during the year. Now, please note, who is selling? Parent is selling. When parent is selling, what is the functional currency of the parents? Euro. What is the currency in which the transaction has happened? Transaction has happened in USD. So, this is a foreign currency transaction for whom? For the parent. See, for the subsidiary, this is a transaction in USD. So, it is not a question of foreign currency transaction, right? At the year end, a balance of the same amount is outstanding as receivable from S. So, there is a monetary item which is receivable from S. Will this be a part of net investment in foreign operation? Friends, let me tell you, trade receivables and trade payables will not form a part of net investment in foreign operation. Long-term loans, long-term receivables, long-term payables, they will form a part, but trade receivable, trade payables will not form a part. Okay. It has been observed that such balance amount has been continuing as receivable from S year on year, even though the payment in respect of these balances are expected to be received in foreseeable future. But if you look at the year end, then we see this balance as outstanding every year. So basically what happens is, let's say billing of 300 is done. This amount is outstanding at the year end. Next year, this amount is paid, again a billing is done. Okay, similar like this, it keeps on continuing. So closing balance is always as 300. But can we say that this amount is not expected to be settled in the foreseeable future? We are actually settling the amount. A new transaction is creating that outstanding balance. So we cannot consider this as a net investment in foreign operation. It's a normal monetary item. Okay. In addition to the trading balances between P and S, P has lent an amount of $500 to S that is not expected to be repaid in the foreseeable future should the exchange difference, if any, be recognized in the P&L. So the first part of the question, there are two parts. One, there is a trade receivable balance in what? In foreign currency. Okay, foreign currency of whose? Foreign currency of the parent. Now that is a monetary item. Monetary item has to be restated. When you restate the monetary item, whatever is the gain or loss, that will be recognized in the P&L. Okay, P&L of whom? P&L of the parent company. So you can write it like, because there is a foreign currency transaction and the amount is outstanding at the end of the year, this being a monetary item, it has to be restated. Whatever is the exchange gain or loss, that will be recognized in the standalone financial statements of P Limited, okay, or of the parent company. Now, when consolidating, what will we do with this gain or loss? Still, it will be recognized in the P&L because it is a monetary item. Now, the second part of it, which says there is a loan amount of $500 which is not expected to be repaid in the foreseeable future. So if a monetary item in the nature of a long-term receivable is not expected to be repaid in the foreseeable future, then it forms a part of net investment in foreign operation. When it forms a part of net investment in foreign operation, the gain or loss will be recognized in the P&L in the standalone financial statements, whereas in the consolidated financial statements, this amount, the gain or loss on this loan which is not expected to be repaid, that will be recognized in OCI and not in the P&L. Then reading further, modifying the above illustration, suppose that for tax reasons the permanent funding, that is the loan amount extended to S, is made via another entity in the group T rather than from P directly. That is, on the directions of P, T gives the loans to S. T is also a subsidiary of P. Where should the exchange difference, if any, be recognized? Now what has happened here actually? So there is this parent company, okay, then there is this subsidiary company, there is this another subsidiary company called T. Now, who gives the loan? T gives the loan to S, okay, T is giving the loan to S. On whose instruction? So basically P gives an instruction to T to give the loan to S. Now, where will we recognize the gain or loss? See, it is assume for a moment the functional currency of T is also Euro. The functional currency of T is also Euro, okay. Parent also is Euro, T is also Euro. Now, in the standalone financial statements of T, T will do a remeasurement or restatement of this loan. Please note, loan is a monetary item. Loan receivable or payable is a monetary item. So, in the standalone financial statement of T, T will recognize the gain or loss on the restatement of the monetary item. Then, while preparing the consolidated financial statements of the entire entity, in that case, now because this particular loan is not expected to be settled in the foreseeable future, in the consolidated P&L, you will not recognize the gain or loss on remeasurement. Where will you recognize that? In the OCI. Now, some of you may have a doubt, sir, it is not given by the parent company, it is given by another subsidiary. It does not matter. We are preparing a combined financial statement or consolidated financial statement. In that case, if there is a gain or loss on a monetary item which is a part of net investment in foreign operation, so for P, it is a part of net investment in foreign operation. But sir, it is given by T, how does it form a part of net investment in foreign operation? Indirectly, if you see, it is a net investment in foreign operation. So when you are preparing the group's financial statement, the gain or loss will not be recognized in the P&L, it will be recognized in the OCI. Sir, will it make a difference if this T has another functional currency? It does not have euro as a functional currency, it has, let us say, some other currency, say pound as the functional currency. Even in that case, the answer will not change. Okay. To the extent there is a gain or loss on monetary items which are a part of NIFO, that will be taken to OCI in the consolidated financial statement. Sir, in standalone you will take it to the P&L. Let's now move on to the next topic and understand what happens to the intra-group transactions and balances. Okay, now here we'll take an example of a consolidation and see what do we do with intra-group transactions and what do we do with intra-group balances. Now, first thing, if you remember the basics around consolidation, you would understand that the intra-group balances should be eliminated. So, say for example, there is a holding company and there is a subsidiary company. Okay. Now, this holding company, for example, has given loan to subsidiary 1 lakh. Forget the currency for a moment, right? So, here in the holding company books, what is this? This is an asset, right? Because it has given loan, this is an asset. In the subsidiary company, they have received loan 1 lakh. This is a liability. Now, think of it as there is a father, there is a son. Father has given loan to the son. Okay. Now, in the standalone statements, the father will say, I have a loan receivable. The son will say, I have a loan payable. But if you look at the family as a whole, and if you have to communicate to the outsiders, will the family say there is a loan receivable and loan payable? No, because everything is within the family. So, what do? You will net off or you will set off the loan receivable and loan payable, and in the consolidated financial statements, this amount will be 0. So, from the asset side, you will remove that 1 lakh of loan receivable. From the liability side also, you will receive that 1 lakh of, you will remove that 1 lakh of loan. So, net in the consolidated financial statements, you will show this amount as 0, right? That is the logic of consolidating intra-group transaction, that is within the group transactions. Now, when we talk about consolidation and there are foreign currencies involved, say for example, this is given in INR, okay, the subsidiary company is in USD, the functional currency is in USD. So, the subsidiary company will record this loan in USD, correct? So, 1 lakh is the loan given here, and assume for a moment that INR USD exchange rate is 50, just for argument's sake, okay. INR USD exchange rate is 50. Now, if INR USD exchange rate is 50, what is the loan liability? 1 lakh divided by 50, that is 2000, correct? Now, let us say we are at year end. Now, at year end, what do? The balances which are denominated in foreign currency, and if they are monetary items, we restate. So, basically, the foreign currency monetary items are restated. Now, think of it. Does the holding company have anything which is designated in foreign currency? See, they have given loan of 1 lakh INR to the subsidiary. They have recorded it as 1 lakh INR. It is not a foreign currency transaction for them. So, they will not do any restatement. Look at the subsidiary company. The subsidiary company has taken a loan in INR, which is a foreign currency for the subsidiary. They have converted that into functional currency and showed the loan as 2000 payable. So, at the year end, this loan has to be restated. This loan has to be restated. Now, say for example, the USD INR exchange rate has moved from 50 to 55. Okay, so year end exchange rate is 55. Now, think of it from the subsidiaries company point of view. Do they need to pay $2,000 or do they need to pay 1 lakh? They have to pay 1 lakh. They are not paying $2,000. They have to pay 1 lakh. Now, if they have to pay 1 lakh, how many dollars do they need at the year end? So, you will see restated loan or remeasured loan balance, if you talk about, that is 1 lakh has to be paid, and right now the exchange is 55. So, they need only $1818.18. What does that mean? It means that there is an exchange gain of 2000 minus 1818.18, which comes to 181.82, or you can round it off to 182. So basically, in the standalone financial statements, the subsidiary company will say, oh, I have a monetary item, there is a monetary liability designated in foreign currency, let me restate that. Now once I restate that, there may be a gain or there may be a loss. Now where do you take this gain or loss? This gain or loss will be taken to the P&L in the standalone financial statements, right? Now, when we have to consolidate, what should we do? Now, whenever we are consolidating, one thing we know is that the intra-group balances have to be offset. Basically, this 1 lakh of loan will be offset against this restated loan of 1818.18. Okay, this 1 lakh of loan will be offset against the restated loan balance of 1818.18. So, at the year end, this closing balance of loan payable in the subsidiary company's book will be offset against this 1 lakh in the holding company book. So, in the consolidated financial statement, you will not have something called loan. But now tell me one thing, what do we do with this exchange gain? Should this exchange gain be taken to the P&L of the consolidated financial statements? Now, for that we have to understand one more logic. What is that logic? See, initially we got $2,000. The company got $2,000 or the subsidiary got $2,000. Assume you got that $2,000 and you have kept in your pocket. After 1 year or at the year end, you are required to give only 1818.18 to the holding company. You are required to give how much? 1818 to the holding company. Means what? We are left with this 181 or 182 of USD balance in our pocket. See, I got $2,000. I gave $1,818 back to the holding company. I am left with $182. I am just rounding up the number so that it is easier for us to understand. This $182 is actually the cash in hand with the subsidiary, right? So, this is a gain. Now, what do we do with this gain? This gain has to be recognized in the consolidated financial statements. This has to be recognized in the consolidated financial statements. You will credit it to the consolidated P&L, right? Now, as far as the holding company is concerned, holding company will get their 1 lakh. They will get their 1 lakh because that is equal to this 1818, and this extra money is also saved. It is a gain. So, it has to be recognized in the P&L, right? Now, if this loan, which is a monetary item, if this was a part of the net investment in foreign operation, then will we take it to the P&L? Just recollect what you learned in the previous modules. You will not credit it to the P&L. You will take it to the other comprehensive income, right? So, two things: exchange gain or losses, monetary items, you will take it to consolidated P&L. Okay, if it is a monetary item and if it is pertaining to NIFO, then you will take it to OCI. Okay, now you understood the reason why we should recognize this gain. Don't say that, because this is an intra-group transaction, this gain has to be eliminated. This gain cannot be eliminated, because actually if you see that $2,000 that the entity has received is worth much more. How much is it worth now? It is worth It is worth 2000 multiplied by 55, which is 1,10,000. Okay, original amount is 1 lakh. So, you actually have made a gain of 10,000, basically the exchange gain, and if you translate it at the closing rate, what do you get? You get the same 181.82. So, that is the logic what you need to understand when we talk about intra-group transaction. So, this is one transaction where I talked about a loan. Now, the other transaction, which is slightly more complex, is when there is a trading transaction. For example, the holding company sells goods to the subsidiary company, or the subsidiary company sells goods to the holding company. So, let us take one more example. We have a holding company. Let us say functional currency is INR. Subsidiary company, functional currency is USD. Okay. Holding company sold goods. Okay. And assume for a moment they are not invoicing in INR, they are invoicing in USD. Okay. So, they sold goods worth how much? USD? $1,000. Okay. Subsidiary company purchased goods worth $1,000. Now, what will be the accounting entry in each of these books? In the holding company, they would say account receivable I'll put the name subsidiary company, to sales. How much? 1000 USD multiplied by the exchange rate. Assume for a moment exchange rate is 80. I'll put here. USD INR exchange rate is 80. So, you will debit the subsidiary company by 80,000 and you will credit revenue also by 80,000. Right? Account receivable to sales. Now, when it comes to subsidiary company, what is the accounting entry they will pass? They will say inventory debit to account payable to holding company. Right? How much? $1,000 and $1,000. I am writing one below the other so that because I am some space constraint. So, the one is debit and one is credit. Okay. Now, let us say this inventory is not yet sold. First thing. Second, this transaction is not yet settled. So, at the year end, inventory in hand 100% and transaction not settled. Okay. Now, in each of the financial statements, in the individual financial statements, you have to do the measurement for monetary items. See, you have account receivable. Account receivable is a monetary item. Now, as far as monetary items are concerned, you have to recompute the balance at the end of the period. Gain or loss is taken to P&L. Assume for a moment, year end, USD INR is say 85. Okay. So, what will you do? $1,000 receivable and the exchange has gone up by 5, you have a gain of 5,000. So, you will say account receivable subsidiary 5,000 to exchange gain 5,000. Okay. What will the subsidiary company do? See, the subsidiary company's functional currency is USD. They have purchased something in USD. For them, there is no need to restate anything. So, do they need to restate inventory? Inventory is a non-monetary item. So, no question of restatement of that as well. Okay. The only thing that you will do is as per Ind AS 2, lower of cost or NRV, and accordingly you will recognize any loss applicable. Assume for a moment there is no loss in this case in the inventory. So, for the subsidiary there is no impact. For the holding company, they said, okay, we made an exchange gain of 5,000. Where will we take this exchange gain? In the standalone financial statements, the exchange gain will be taken to the P&L. There is no doubt about that. Now, at the year end, when we are consolidating the financial statements, we need to do two things. One, this inventory is not yet sold. So, whatever is the profit is still within the group only. Okay, the profit has not been earned by sale to outsiders. The father has sold the goods to the son and the father is saying, I made a profit of so much. But actually speaking, the family as a whole, profit is not yet made because the profit is not yet realized. So, say for example, the profit in the transaction is 10,000 INR. Okay. Now, what do you do with this 10,000 INR? You will eliminate the profit by reducing value of inventory and reducing consolidated P&L balance, right? So, because here they would have accounted it at $1,000. Okay. Now, this inventory, it would be carried at cost in the individual financial statements. When you consolidate, the cost will include some element of profit. What is the element of profit? The profit that is earned is 10,000. So, this profit component will be reduced from the inventory value. That is the first thing. Second, you have this account receivable which you have restated and made an exchange gain of 5,000 or recognized an exchange gain of 5,000. While consolidating the financial statements, you will recognize this exchange gain in the P&L. You will take this exchange gain in the P&L. Now, you may have a question that why are we recognizing this exchange gain or loss in the consolidated P&L? Because there is something worth $1,000 lying in US. Okay. And when you convert that into INR, you will get 5,000 extra. So, that gain has to be recognized. Okay. That is why we recognize the gain in the consolidated financial statements. Okay. Because ultimately the holding company will receive $1,000 and that gain has to be recognized in the consolidated P&L. Now, one more thing that will happen is when you are consolidating this account payable will be converted at the closing balance and the account payable will also be 85,000. Here the account receivable is 85,000, there the account payable after conversion is again 85,000, and then whatever is the difference that will be accumulated as a part of the OCI. Okay. The other thing that you have to keep in mind is in the subsidiary company's balance sheet there is inventory worth 1000, there is account payable worth 1000. Okay. Inventory 1000, when you convert it, it will become 85,000. The account payable 1000, it will also become 85,000. So there will not be any gain or loss, right? And when you consolidate, the only gain that will sit in the entire financial statement or the consolidated financial statement is the gain or loss, the gain on restatement of this account receivable, which is 5,000. So the summary of the discussion is, when you are consolidating financial statements, intra-group balances must be eliminated. Any unrealized profit on the transaction should be eliminated, and thirdly, exchange gain or loss that is recognized in the standalone financial statements, that must be recognized in the consolidated financial statements as well. Let's have a look at a question on the concept that we have just discussed regarding consolidating the financial statements and the treatment of foreign exchange differences. Okay. So M Limited is engaged in the business of manufacturing of bottles, pharmaceutical companies, etc. Okay, and there is a company called M Limited. Then it has a wholly owned subsidiary G Limited, which is engaged in the business of okay, it's also engaged in the business of pharmaceuticals. Main thing starts from here. G Limited purchases the pharmaceutical bottle from its parent company. The demand of G Limited is high, and hence to cater its shortfall, G Limited also purchases the bottles from other companies. Doesn't matter, right? Actually, if you see, I have told this earlier also, in a lot of questions they give this extra text which is not relevant for our answers. What is relevant here? The holding company M Limited. What is the other one? Subsidiary company G Limited, and there is a purchase and sale transaction, right? Even in case study based question, a lot of time information may not be relevant for the given answer. So you have to be smart enough to understand what information to retain in your mind and what information to ignore. Okay. M Limited sold pharmaceutical bottles to G Limited for euro 12 lakhs. So who sold? M Limited, holding company. Okay. So this is the holding company which sold the pharmaceutical bottles to this particular subsidiary company for how much? Euro 12 lakhs on 1st of February of year 1. The cost of these bottles was rupees 830 lakhs in the books of M Limited at the time of sale. Okay. So there is a sale from M Limited to G Limited, that is holding to subsidiary. What value? 12 lakhs euro. What is the equivalent INR? We do not know what is the equivalent INR, but cost we know is 830 lakhs. Okay. At the year end, that is on 31st of March, all these bottles were lying as closing stock and payable with G Limited. So this transaction has resulted in inventory and a payable in the subsidiary company, and it is still lying in the books of the subsidiary. Okay. Euro is the functional currency of G Limited. What is G? G is the subsidiary. So subsidiary company functional currency is euro, and the bill was also looks like raised in euro, because that is what they said, right? They sold it for euro 12 lakhs. So this transaction is denominated in euros, which is the foreign currency for the holding company. For the subsidiary company, it is a domestic transaction only. Indian rupee is the functional currency of M Limited. Following additional information is available. Exchange rate on 1st of February of year 1, 83, that is on the date of transaction. On 31st of March, 85, that is at the end of the year. Provide the accounting treatment for the above in the books of M and G. Also show its impact on the consolidated financial statements. Support your answers by journal entries wherever necessary in the books of M Limited. So M is the holding company. So in the books of M Limited, journal entries, and we can also give in the subsidiary company. Nothing great. We have already done a similar example earlier. So using the same concepts, we can solve this question. So let's get into that. Now in such questions, it always makes sense to note down quick facts so that you are not confused while reading the question. Okay. So we have M Limited and G Limited, holding INR, G Limited, subsidiary euro. Okay. Now what happens? On the date of transaction, sales on which date? 1st of February of year 1 in euro. In euro, it is 12 lakhs. So I am just writing 12. Okay. Now what is the equivalent INR? Equivalent INR is 12 multiplied by 83. That is 12 multiplied by 83. That gives us 996. Okay. Now books of M Limited. or you can leave some space, or you can actually do it on the next page so that you know the workings are on a single page and the journal entries are on the next page. Okay, books of M Limited and books of G Limited. Books of M Limited, sales. So G Limited account debit to sales at what value? 996 lakhs and 996 lakhs. Now one more thing friends, here cost of goods sold in INR terms is given to be how much? 830 lakhs. So profit on sale will be how much? 996 minus 830, which is 166. That is what the holding company will record. Now coming to the subsidiary company will say inventory debit, this is all in euro, okay. How much? 12 lakhs, and to M Limited 12 lakhs, which is payable, right. Now coming to the year end, which company has this foreign currency monetary item? The holding company or the subsidiary company? Think of it. Holding company functional currency is INR, transaction is in euro. So for the holding company, this is a foreign currency monetary item. Now because it is a foreign currency monetary item, we have to restate them, or we have to recompute the balances as at the end of the period. So what the holding company will do is, they will recompute the balances. Receivable on 31st of March of year 1, okay. How many euro? 12 lakhs euro. 12 multiplied by 85 is the rate. So 85 multiplied by 12, you get 1020. So there is a gain. That gain is the comparison between this 1020 and 996. So there is a gain of 1020 minus 96, that comes to 24. Okay, right. So gain is 24. 24 what? 24 lakhs INR. Where will we recognize this gain? Standalone P&L, you will recognize the gain. So here you will say G Limited account debit 24 to exchange gain 24. Okay, it's very simple. So P&L, sales 996, profit on sale 166, and exchange gain of 24 in the standalone financial statements. Now that we have understood what is to be done in the standalone financial statement of the holding company and what do you do in the books of the subsidiary company, let us now move on and see what happens in the consolidated financial statements. Now friends, please remember, M Limited, the functional currency is INR. The subsidiary company, which is G Limited, the functional currency is euro, right. Now what you need to do is, you need to convert the euro financial statements to INR. And how do you convert that? How do you translate that? By applying the translation principles that we have understood. So all the assets and liabilities will be converted using the closing exchange rate. Okay. So what we will do is, we will translate the financials from euro to INR. Okay. Now there are only two items. We will not be incorporating lot many items. With those two items only, inventory and you have trade payable. Inventory why? Because we have purchased. Trade payable because we have to pay, right. Now you have in euro, balance is 12 and 12, always at the closing exchange rate. Now the study material has converted this using 83, which is not correct, because when you translate the financial statements, it has to be done using the closing exchange rate only. So euro exchange rate 85 and 85, INR will be 12 multiplied by 85, 1020 and 1020. Now these financial statements will be consolidated with the parent company's financial statements. Now in the parent company financial statement, parent companies, that is M Limited, balance sheet. Okay, what all will you have in the balance sheet? You have account receivable at what rate? Closing rate, because we have restated it is a foreign currency item, so it is at 1020. Then do we have inventory? We do not have inventory. Then do we have any other asset related to this transaction? No other asset. Then the other thing we have is profit on sale, that will be on your equity and liability side. Profit on sale, we had calculated how much was the profit on sale, 166. 166 is the profit on sale, then profit on, then exchange gain, that is 24, right, and others. We can have a balancing figure. See, I am showing you this so that you understand the flow of transactions, okay. So, the others is 830, right. Now, this brings the total of the liability side also to 1020. Now, when you consolidate, what happens? You have a liability here, you have a corresponding contra asset here. Holding company says there is an asset, the subsidiary company says there is a liability. So, you will knock these two off and both of them will be eliminated. So, there will be no account receivable, there will be no trade payable. Then, you have this inventory of 1020 which you have to incorporate in the financial statement. Now, this 1020 of inventory that you will incorporate in the financial statement has profits. What are the profits? One profit is the sale profit, which is this 166. Okay. Then we have translated this at a higher rate. See, sale was booked at 83. Okay. So, the notional cost, if you see, to the subsidiary should be at 83 only. But now we have converted it. Converted using what? Converted using 85. So, additional 2 rupees of profit on translation of that item appears, right. So, this 1020 comprises of, if I just have to break it down here, inventory, cost to parent is 830, right. Then profit on sale is 166 and translation profit is 24. Okay. So, you sum all of these, you get 1020. Now, this 1020 of inventory has to be brought down to what value? To lower of cost and net realizable value of the entire group. What is the cost to the group? Cost to the group is 830. What is the net realizable value? We don't have it, so we can assume that it will be higher than the cost. So, inventory, when you prepare the consolidated financial statement, so I am preparing it here, consolidated financial statement, you have inventory. Okay. Now, this inventory will not be valued at 1080, it will be valued at cost 830. Sir, then where will we take this difference of 830 and 1020? The difference comes to how much? 190. Where do we take that? You will eliminate the profit that you had booked earlier, and this profit on translation will also be eliminated because it is still within the group. Okay. So, that impact will be there on equity and liability. Liability side, if you see, you will have the impact, this profit, so reserves, whatever you had, 166 plus 24, entire will be set off by 190, so this actually becomes 0, okay. Then others, you will have it as 830, the consolidated balance sheet tally. Now, what I am trying to bring about with this, illustration is, the inventory did not go out of the group. See, it is like taking from one pocket and keeping in another pocket, okay. So, holding company sent inventory costing 830 to the subsidiary company, and the subsidiary company still has it with itself, which means for the group, at the group level, the inventory has a value of 830 only, and that is why we will record the inventory at 830. Any unrealized gain has to be eliminated. So, whatever was the gain on restatement of debtors and all of that, that we have eliminated. Now, because the inventory is within the group and the cost is 830, the unrealized profit which you have not yet realized, you have not yet sold it outside the group, as far as it is related to inventory, that has to be eliminated. Okay. What about this exchange gain? Exchange gain will remain there. See, this exchange gain is gain on restatement of debtor, that is not on inventory. Here, we got a translation gain on inventory because we had initially booked at 83 and now we are incorporating it at 85. That extra gain what we have got, that also has to be removed because on inventory you cannot recognize that gain. See, if it was a monetary item, the gain on that can be recognized and that will be shown in consolidated financial statement as well. But as far as inventory is concerned, because it has to be shown at cost, you will be showing it at cost, and the difference between this 1020 and 830, that will be eliminated from the consolidated reserves. Let's have a look at another question. This is also on similar lines of what we have discussed in the previous illustration. Global Limited, an Indian company acquired on 30th of September 2001 or 30th September of year 1, 70% of the share capital of Mark Limited, an entity registered as a company in Germany, and the functional currency of Global Limited is rupees, and its financial year end is 31st March of year 2. So, simple thing, there is an Indian company, they acquired 70% of the share capital of Mark Limited. So, Mark Limited now becomes subsidiary, but it is not a wholly owned subsidiary. Okay. Accordingly, the balances have to be split between the owners of the parent and the non-controlling interest. Okay. Functional currency of Global Limited is INR. The one which is in Germany, they have not mentioned the functional currency, we can assume it to be, euro currency maybe. The fair value of the net assets of Mark Limited was 23 million euro and the purchase consideration paid is 17.5 million euro on 30th of September of year 1. So, on the date of acquisition, fair value of net assets is 23 million. The purchase consideration that is paid is 17.5 million. Now, will there be a goodwill or a capital reserve? Don't directly compare 23 and 17.5 and say that we paid less and hence there is a capital reserve. No, you have to see you have to see what is 70% of the net asset share and accordingly you have to calculate the goodwill. The exchange rates as on 30th of September of year 1 was rupees 82 per euro and at 31st of March of year 2 was rupees 84 per euro. What is the value at which goodwill has to be recognized in the financial statements of Global Limited as on 31st of March of year 2? Now, when we prepare the consolidated financial statements as on 31st of March of year 2, there has to be a goodwill component because of the subsidiary. Okay. Now, why am I saying goodwill? Because the question itself says what is the value of goodwill that has to be recognized. Now the key question is how do we compute goodwill? That is one part. The second part is at what exchange rate should we compute the goodwill? So, say for example, you calculate, okay, 23 million is the net asset, 70% of that comes to 16.1 million, amount paid is 17.5 million, the difference is 1.4 million, 1.4 million is goodwill. Now, when you recognize it in the consolidated financial statements, should we take the exchange rate on the date of acquisition or should we take the closing exchange rate? What the standard says is, in IND 21, what it says is, the goodwill arising on acquisition should be considered as an asset of the foreign operation. What do we consider? As an asset of the foreign operation, and hence you will have to apply the principles of converting the assets and liabilities that you do at the time of translation. Meaning to say, goodwill will be recognized in the consolidated financial statements using the closing exchange rate, not at the date of acquisition but the closing exchange rate. And what is the reason for that? Goodwill is considered to be an asset of the foreign operation and you will apply the normal translation principles that we have learned. Okay, that is the first part. Then first let's finish the first part, then we'll come to the second part. So, while preparing the consolidated financial statements, when you compute the goodwill is considered to be the asset of the foreign operation. So, here what is the value of goodwill? Net assets of the subsidiary in euro is given to be 23 million on the date of acquisition. So, calculation will be done on the date of acquisition in the foreign currency, but reporting will be done using the closing rate. Okay. So, 23 million is the net assets. So, you can see euro in million. Share of holding 70%. So, share in net assets is 23 multiplied by 70%, that comes to 16.1. Consideration paid is how much? Consideration paid is 17.5 million, 17.5 billion. So, goodwill is 17.5 minus 16.1, that comes to 1.4. This is in euro. Okay. So, goodwill as on 31st of March of year 2 is computed using the exchange rate, which is the closing exchange rate. Now, why closing exchange rate? All the assets and liabilities are converted using closing exchange rates. That is the reason. Calculation done on the date of acquisition, conversion considering the closing rate. What is the closing rate? They have given the closing rate to be 84. So, 1.4 multiplied by 84 multiplied by 1.4, you get 117.60. So, this is the value of goodwill to be incorporated in the financial statements, that is the consolidated financial statements of the holding company. Okay. Now, let us look at the second part. Mark Limited. Who is Mark Limited? Subsidiary. Mark Limited sold goods costing 2.4 million euro to Global Limited for 4.2 million euro during the year ended 31st March of year 2. The exchange rate on the date of purchase by Global Limited was 83 per euro and on 31st of March was 84 per euro, same as above. The entire goods purchased from Mark Limited are unsold as on 31st of March. Determine the unrealized profit to be eliminated in the preparation of consolidated financial statements. Now, what happens here? You have to see. Subsidiary sells to holding. Okay. So, when subsidiary sells to holding, subsidiary recognizes profit. Right. Now, this profit which is recognized by subsidiary has to be eliminated. So, you have to see how much of profit has the subsidiary recognized and you have to eliminate that profit. Okay. So, sale value in euro is given to be how much? 4.2. Okay. And cost is given to be 2.4. So, profit is 4.2 minus 2.4, which is 1.8. Now, because the holding company has not yet sold the goods to outsider, it is still within the group, you cannot recognize this profit. This unrealized profit has to be eliminated. So, 1.8 million euro of profit has to be eliminated because it is not yet realized, right. So, profit to be eliminated is equal to 1.8 million euros. Now, this 1.8 million euro, when we convert to INR, which rate should we consider? Should we consider the date of sale? Should we consider the closing rate? Friends, please remember, for P&L items, conversion is done using the date of transaction. So, what is the exchange rate on date of transaction? Exchange rate on date of transaction is given to be 83. So, profit in INR to be eliminated is 1.8 multiplied by 83, that is 149.40. So, the profit that has to be eliminated is 149.4. Now, please remember, this profit is being eliminated because this profit was recognized in the books of subsidiary, and because it is not yet realized, it is not yet sold to outsiders, the portion of that profit has to be eliminated. Now, study material has given some explanation like, purchase of inventory is an item of expense and hence we have to use the date of transaction. That is not correct. We are eliminating it because the profit and loss item has to be converted using the exchange rate on the transaction date. So, when we talk about the profit to be eliminated, that is 1.8 million euros, it has to be converted using the exchange rate on the date of transaction and not because it is an item of expense. Okay, that logic is flawed, right? So, this is how you solve the problem, very simple one. So, basically what we have learned here is how much of profit has to be eliminated, that is one aspect, right? And in the previous portion we have seen how do we calculate the goodwill. And in the earlier problem we have seen what happens at the time of restatement or remeasurement of monetary items. So now so far we have understood that whenever there is a foreign operation, let us take a case of a subsidiary. Okay, it makes things easier for us to understand. There is a subsidiary. This subsidiary prepares financial statement in its own functional currency. Let us say the functional currency is USD, right? Now we have a holding company whose functional currency is say INR. Then what do? We translate these financial statements to INR using the principles that you have understood, that is the assets and the liabilities have to be converted using the closing exchange rate. This is what you have understood. And the P&L items will be converted using the date of the transaction. And because of this, there would be a difference that would arise and we will accumulate that as foreign currency translation reserve under the OCI. Okay. Now, assume for a moment this subsidiary is only a 60% subsidiary. It's not a 100% subsidiary. Now, if this is only a 60% subsidiary, this translation reserve does not wholly belong to the parent company. Okay. So, we have translated the financial statements. When we translate the financial statements, we got this difference. We called it as foreign currency translation reserve. And if it was a 100% subsidiary, entire amount could have been recognized in OCI in the consolidated financial statements. But if it, let's say, is only a 60% subsidiary, then you have to split this into two parts. OCI for 60% and remaining 40% share will be for NCI, that is non-controlling interest. So, the thing that you have to keep in mind is whenever there is translation of financial statement and when you are consolidating the financial statements, if it is not a wholly owned subsidiary, then the portion which is attributable to the non-controlling interest has to be credited or debited to the non-controlling interest and not to the OCI. That is one thing you have to understand. Then what we also understood is this foreign currency translation reserve that is recognized will be carried on in the OCI till the time you dispose the subsidiary. Now what happens when you dispose the subsidiary? First of all, what is the meaning of disposal of subsidiary? Disposal basically means sale, right? So say for a moment, currently you have holding company A, subsidiary company B. This is the holding company, this is the subsidiary company. A holds 100% of the share capital in B. So it is a wholly owned subsidiary. Say for example, after a few days, after a certain period of time, A sold, another party called C or another investor called C, A sold 20% stake which it holds in B to C. So basically now after the sale, C holds 20% in B, A holds 80% in B. Okay. So earlier it was 100%, now A holds 80%, C holds 20% in B. Now tell me one thing, do we consider this sale of 20% to C as a disposal? See, in a way there is a sale, right? The investment in B Limited has been sold off to somebody else, that is C. So there is a sale, but do we call it a disposal of subsidiary? For that you need to answer one question, that is, does A still have control over B? So the thing that we need to understand is there a control? Does A still control B? If A still controls B, and in this case because it still holds this 80% stake, A still controls B. Till the time the control is not lost, we cannot call it a disposal. So though 20% of shares has been transferred to C, A still controls the subsidiary, there is no disposal of the subsidiary. So in that case what do we do? Now because A does not have 100% interest, A has only 80% interest, the portion which pertains to this 20% that is transferred to C. So from the FCTR, foreign currency translation reserve, okay, let us say you have 100 of balance, you have a balance of 100. Now earlier entire 100 was recognized in OCI. Now when the entity reduces its stake, when the reporting entity reduces its stake, but there is no loss of control, it still is controlling the subsidiary, what should be done is, proportionately amount from OCI has to be transferred to NCI. So what I mean by that, say for example, now 80 pertains to the parent and out of this 20 pertains to NCI, just for example, okay. So what you need to do is, this 20 should be transferred from OCI to NCI. And please note friends, all of this is in the consolidated financial statements that we are talking about. In the standalone financial statements, you will not have this other comprehensive income coming from foreign currency translation reserve. Only when you are consolidating the subsidiary, you get this FCTR in OCI. And if there is a disposal, now when would a disposal happen? Say for example, from 100%, it comes down to 20%. In that case, you can do the reclassification from OCI to PNL, but if the control is still retained, if the control is not lost, you cannot reclassify it. You have to transfer from OCI to the non-controlling interest. Now, even if there is a full disposal of the subsidiary, now say for example, another case, A holds 60% stake in B, okay, and NCI holds how much? 40%, okay. Now, when you calculate FCTR, what will you do? To the extent of 60%, you will take it to OCI. To the extent of 40%, you will take it to NCI. Now, let us say A Limited fully sells off its investment in subsidiary. Means A has fully sold off 60% stake. Now, this 40% portion which was attributable to NCI, the 40% of FCTR which was attributable to NCI, that will be de-recognized because that portion is no longer applicable, it will be de-recognized. So, do we classify this to the profit and loss? You cannot, because that is something which pertains to the non-controlling interest. You should not touch that, that will be just de-recognized and eliminate, and once you de-recognize, it will no longer appear in the consolidated financial statement, right. Now, this is one fundamental example that you need to understand before we actually start working out problems on this, okay. So, friends, as far as disposal of a foreign operation is concerned, there could be multiple scenarios, and for each scenario there are different treatments. First, if there is a full disposal means you have sold off everything, then the treatment is pretty simple. Now that full disposal could be of a subsidiary, a joint arrangement, a branch, anything. Whenever there is a full disposal, what will we do? Whatever we have recognized in the OCI, that is the foreign currency translation reserve, will be transferred to the P&L. A very simple treatment. Now, the second part is where it is slightly tricky, where there is a partial disposal. Now, under partial disposal also there could be multiple scenarios possible. If the partial disposal is of a subsidiary and because of the partial disposal, the entity has lost control. Now, when the entity loses control, what it means? The subsidiary no longer will be consolidated in the financial statements as a subsidiary. Okay. So, if there is a loss of control, then in that case, it is as good as a disposal. So, you will transfer the FCTR balance from the OCI to P&L because there is a loss of control. Similarly, if there is a partial disposal of a joint arrangement or an associate, even in that case, you will transfer the proportionate amount from the OCI to the P&L, right? That is the second aspect. Then, the third aspect is where there is a disposal but control is not lost. Means you have sold off some shares but the control over the subsidiary is not lost. In that case, what you do is the proportionate portion, proportionate amount will be transferred from the OCI to the NCI, that is from other comprehensive income to the non-controlling interest. And in no case, when you dispose of subsidiary, the non-controlling interest portion of the FCTR will be reclassified to the P&L. Okay, that will not be done because that is not belonging to the reporting entity. Now, I have a question for you. What if there is a foreign branch which is not a subsidiary or an associate or a joint arrangement and we have done a partial disposal of that foreign branch? Now, in that case, what happens to the cumulated foreign currency translation reserve in the OCI? What do we do with that? Now, in that case, what the standard says is, if it is a foreign operation which has been partially disposed of and that is not a subsidiary or a joint arrangement or an associate for which there is a separate treatment, we have already discussed that. In those cases, what you need to do is, the proportionate portion that you have disposed of, to that extent you need to transfer or you need to reclassify from OCI to the P&L. So, what it basically means is, say the balance is 1000, we have sold off 30% of the branch to somebody. So, 30% of 1000, that is 300 should be reclassified from OCI to the P&L. Okay, so whenever you sell off a foreign operation partially and that is not a subsidiary, this is the particular treatment. So, what if it is a subsidiary? See, if it is a subsidiary, then you have to transfer from OCI to non-controlling interest if you have not lost the control, and if you have lost the control from OCI to P&L, right? So, that is the difference in treatment there versus a normal foreign operation. Most of the times we get questions in the examination around the subsidiaries, okay. Very rarely do we get around foreign operation, but even if you get it, the thing that you need to understand is proportionately you have to transfer from OCI to the P&L. So basically, if there is a full disposal, entire amount will go to the P&L. If there is a loss in control of a subsidiary, then entire amount will be classified from OCI to P&L. If partial disposal of subsidiary without losing control, then from OCI to NCI. If it is a partial disposal of other foreign operations, then proportionately you will transfer from OCI to the P&L. Let's now have a look at a question on disposal of a subsidiary. Okay. Now, friends, in this question there is a concept related to gain on disposal, which you will be able to understand in much more depth when we do consolidated financial statements, right? So, right now you don't break your head too much into this question. What you need to understand here is, what do we do with the foreign currency translation reserve? That is what you need to understand, right? So, let's have a look at the question. Parent P acquired 90% of subsidiary S some years ago. So, P acquired S. He now sells its entire investment in S for 1500 lakhs. So, for 1500 lakhs, they have sold the subsidiary or the stake rather. The net asset of S are 1000 and the NCI in S is rupees 100. Means what? See, the total net assets in S is 1000, okay, and NCI share in that is 100. How is NCI share 100? See, the holding company has 90% stake. So, the non-controlling interest will have 10% stake. So, 10% of 1000 is nothing but 100, right? The cumulative exchange differences that have arisen during P's ownership are gains of rupees 200 lakhs. So, 200 lakhs is the cumulative gain which has arisen as a result of translation. Again on this 200, 90% that is 180 belongs to the holding company and 20 that is 10% belongs to the non-controlling interest. So this has resulted in P's foreign currency translation reserve in respect of S having a credit balance of 180 lakhs with the cumulative amount of exchange differences that have been attributed to the NCI at 20 lakhs. So out of 200, 180 is in the OCI, owner's OCI other comprehensive income balance, and 20 is attributable to the non-controlling interest. Calculate the P's gain on disposal in its consolidated financial statement. Now, one quick method to calculate the gain is to see what did we sell, what is the value of those things that we have sold. The difference will be the gain, and of course the reclassification thing from OCI to P&L. So a quicker way, that is a faster way to get is sale value is 1500, the share of P is 90% and the net assets are 1000, so it comes to 900. So 1500 minus 900 is 600 plus 180 which is lying in OCI, that has to be transferred to P&L, that is also a gain on disposal. So 600 plus 180, 780 is the gain on disposal. That is a quicker way to do it, but let's put it down on pen and paper, in my case in Excel, and see how do we calculate this gain or loss. So disposal proceeds is 1500, net assets is 1000 less share of NCI 100, okay. Then, so 1000 minus 100 you get 900, and gain reclassification of FCTR is 180 because 20 pertains to the non-controlling interest. So the total gain is 1500 minus 900 plus 180, that comes to 780. The other way to understand this is from the consolidated financial statement. Okay, I am not talking about individual financial statement, because if it is an individual financial statement or standalone financial statement, the sale minus cost of investment will be the gain. In the consolidated financial statement, what is happening? Net assets worth 1000 is going out. So, to net assets 1000. Okay. Then NCI, which has a share in net asset of 100, will be de-recognized. Why de-recognized? Because the non-controlling interest is no longer a part of the consolidated financial statement. Non-controlling interest has a credit balance of 100. So now you have to debit that. So NCI debit 100. Let me put this side so it is easy. Okay. Then what else you will debit? You have received 1500. So bank account debit 1500, right? Then you have to de-recognize the foreign currency translation reserve portion as well, correct? Now that foreign currency translation reserve is lying at two places. Which two places? OCI. So let me add here. OCI, there is a balance of 180. This has to be eliminated. So OCI debit 180. Why? Because you will transfer to P&L. Okay. NCI de-recognized because of loss of control, right? So whatever is the difference, 1500 plus 1, 1600 plus 180 minus 1000, 780 is the gain. So to P&L 780. This is another way to understand the gain or loss. Now here the thing that you need to be perfect about is that the 180 of OCI balance, which represents the foreign currency translation reserve, that has to be transferred to the P&L. Okay. Regarding gain or loss on disposal, the computation of that, as I told you, you will be perfect when we do consolidation, and I don't want to spend too much of time here or bother you too much about that particular computation. Let's now move on and understand few small topics that we have left here and there in the standard, and then we'll move on to the disclosures, and then we'll conclude the standard. The first thing that we have to understand is with regard to change in functional currency. Can the entity select and keep on changing its functional currency whenever it wants? Say today I decided my functional currency is INR. Then in the next year I said no, some sales are happening in US, and if I present in USD, I'll get a better financial picture. Let me change my functional currency to USD. Like this, can we keep on changing the functional currency? And if the answer is yes, what will be the impact on the financial statements? Do we do a retrospective application or a prospective application? So for this, the standard has put out very simply that functional currency is decided based on underlying events, circumstances and transactions, and you should change a functional currency only when those events, those circumstances, those transactions undergo a change. What does that mean? Say for example, in this year, my functional currency is INR because my operations are based out of India, a lot of customers are based out of India. So I have selected the functional currency as INR. After a couple of years, my operations became more US oriented. I started having more sales based out of US. US economy started, impacting the finances of my company. Customers in the US, a lot of suppliers in the US, right? So everything is US based. So because now when such changes happen, then we can change the functional currency from INR to USD. Now, when we change the functional currency from INR to USD, should there be a retrospective application or should there be a prospective application? So the standard says you have to apply the changes in functional currency prospectively, which means from the given date on which you have changed the functional currency, start translating the items into the new functional currency prospectively. Sir, what about the foreign currency translation reserve that we would have recognized in OCI? Continue to recognize that in OCI. You cannot de-recognize it or you cannot transfer it to P&L. So, when there is a change in functional currency, first thing, it has to be applied prospectively. There is no retrospective application. Second thing, the balances on the date of change will have to be converted using the new functional currency, and that will be the basis for further accounting. Third, any amount of foreign currency translation reserve that is recognized in OCI will remain in OCI till the time those foreign operations have been disposed of. Just because you have changed the functional currency does not mean that you will transfer the OCI balance to the P&L. No, that is not allowed. So, the OCI balance will continue to remain in OCI. The transactions will be accounted using the new functional currency, and on the date of change, you will translate your assets and liability balances to the new functional currency. Right? That is how the change in functional currency will be accounted for. Now, whenever there is a change in functional currency, there will also be an impact on the amounts already recognized. See, what happens is we have understood that there can be monetary items and there can be non-monetary items. Right? There can be monetary or non-monetary items which are denominated in foreign currency. For monetary items, at each balance sheet date, you will remeasure. There is no problem. But for non-monetary item, we said we have to take the historical cost only, right? So, say for example, the functional currency is INR and we have purchased inventory worth $1,000. Okay, then what would you do? You would say this is a foreign currency transaction. So the relevant cost in INR is $1,000 multiplied by the exchange rate, say it is 80, and this is 80,000. And considering this value, we will continue to value the item of inventory. That is what we do, right? Now, because the functional currency has changed, we have to even convert these, inventory values, correct? Earlier case was the transaction value multiplied by the exchange rate on the date of the transaction, you get 80,000. Now, say for example, for whatever reasons, we have to change the functional currency from INR to say Euro, from INR to Euro. Now, our new functional currency is Euro. Functional currency is Euro. Okay. Now, this transaction is in USD $1,000. Now, say for example, $1 is equal to 2 euro. Then, the cost of this inventory for our accounting purpose will be $1,000 multiplied by 2 euros, that is 2,000 euros. Okay. So, the thing that we need to understand is, see, as far as the monetary items are concerned, anyways you will do a remeasurement at the balance sheet date. But for non-monetary items, this translated value on the date of change in functional currency, that value will be the historical cost for non-monetary items. So, does this mean that we will not restate the monetary items to euro? I am not saying that. What I am saying is, on the date of change, both monetary and non-monetary, both of these convert to new functional currency. Okay. Then these monetary items anyways will be restated at the end of the period or at the end of the reporting period. For these non-monetary items, whatever value you derive on the date of change, that will be the historical cost. And you will continue to measure that item at this historical cost. So, if you get 2000 euros on the date of change in functional currency, you will continue to measure inventory at 2000 euros. That is nothing but $1000 multiplied by the rate on the date of change in functional currency. Okay, you will not go back in history and say, okay, the transaction date was 2 years back and on that date this was the exchange rate, so that should be the historical cost. That is not the case. The relevant exchange rate is exchange rate on date of change. Use this exchange rate, translate those items into the new functional currency and do a prospective application. Now moving on, the next aspect that we need to understand is what is to be done if the functional currency is the currency of a hyperinflationary economy. Sir, what is this hyperinflationary economy? It basically means a very high rate of inflation. Okay, so there have been multiple countries, multiple economies at different point in time where they have suffered huge inflation rates. So, one of the classic case which I have to tell you is of Zimbabwe. Okay, in case of Zimbabwe, the inflation was so high that they say if something was costing 100 in the morning, by evening it would be 200. So, we are not talking about percentage per annum inflation, we are talking about 100% inflation per day. So, they had to end up printing, currency notes of billions of dollars, and to handle such situation, they had to print currencies. They printed currency notes of billions in Zimbabwean dollars. People apparently, dropped cash on the road, and it was a very bad situation. And high inflation can be seen in other countries also. Okay, they may not be hyperinflation, but still you can see high inflation. For example, we can see in Sri Lanka, something happens in Greece, right? Something is happening around in Turkey. In so many economies, there is this problem of hyperinflation, right? So, when we talk about hyperinflation, we are talking about a very high rate of inflation consistently. Now, say for example, there is a company and let us say this company is set up in Sri Lanka. Okay. Now, the functional currency of this company is the currency of Sri Lanka, right? Assume for a moment this is a hyperinflationary economy. Inflation has gone up, it is at historical highs, and the prices are increasing left, right and center. Now, the impact of increase in inflation has an impact on foreign exchange as well, because higher inflation, higher interest rates, and higher interest rates, all of you are experts in interest rate parity theorem, and you will see that there is a higher exchange rate, the currency depreciates. Even with inflation increasing, the purchasing power decreases, and again the currency also depreciates. So, what I mean by that is, if something is, let us say today worth 100, in Sri Lanka something is worth 100, in USD the same thing is worth 1. Okay, just for example sake. After 1 year, in Sri Lanka this becomes 200, here it is still at 1 or let us say 1.1. So, the currency also depreciates, right? That is the context of hyperinflationary economy. Now, the problem with a currency being a currency of a hyperinflationary economy is that when we restate the financial statements or when we translate the financial statements, they may not give a very true picture or they may not give a very clear picture. Say for example, if you have to translate something, today the exchange rate is USD Sri Lanka 100, after 1 year it is USD Sri Lanka 200. Okay. Now, in such cases, when you translate the financial statements, they may not be comparable. So, what IND AS 21 does is, it prescribes a different treatment or different translation approach for those entities whose functional currency is the functional currency of a hyperinflationary economy. So, to summarize this, if my functional currency is the currency of a hyperinflationary economy, there is a different approach for foreign currency translations. Now, as far as functional currencies of hyperinflationary economy is concerned, what the standard says is pretty simple. First, the standard says go to IND AS 29. Sir, what is this IND AS 29? Don't worry, this is not a part of the syllabus, and this is with respect to financial reporting in hyperinflationary economies. So, whatever is given in IND AS 29, the restatement and other related aspect, first apply that. After applying that, you come to IND AS 21. Now, in IND AS 21, there could be a scenario where you have a functional currency and you have a presentation currency, and this functional and presentation currency are different, right? Now, when the functional currency and presentation currency are different, what do? We convert the functional currency amounts to the presentation currency amounts. For assets and liabilities, we take the closing rate. For P&L items, we take the rate on the date of transaction. But if the functional currency and the presentation currency are currencies of hyperinflationary economies, both of them, so they have to be different currencies. No, yes, they will be different currencies, but both of them are hyperinflationary. For example, you have Sri Lanka here and you have Pakistan here. I am just giving an example. Okay, so you have Sri Lanka here hyperinflationary and you have Pakistan here hyperinflationary economy. Now, if the presentation currency is the Pakistani rupee, what do you have to do? You have to translate this from functional to presentation. Okay, now you have year 1, which is the previous year, you have year 2. If both the currencies are currencies of hyperinflationary economies, the standard says take the closing rate of year 2 or the reporting date and translate this also with 31st March of year 2 and this also with 31st March of year 2 rate. So, if the functional currency and the presentation currency, both of them are currencies of hyperinflationary economies, you will take the closing rate for translation purpose. Closing rate of which date? Closing rate at the end of the reporting period. Sir, for which year? For the year for which the financial statements are being prepared. So, if you are preparing financial statements on 31st of March of year 2, both year 1 and year 2, both of these will be translated using the closing rate. Okay, that is the first thing. Second, if functional is hyperinflationary and reporting is non-hyperinflationary. Okay, so if functional is hyperinflationary, presentation is non-hyperinflationary. In that case, for year 2, take 31st of March of year 2 rate. For year 1, take 31st of March of year 1 date. Okay. The way it has been given in the standard is slightly complicated and it has a lot of text. The essence is this. If both of them are hyperinflationary economies, then take the closing rate of the second year. Ignore the closing rate of the first year. But sir, we are preparing comparative financial statements. How can we change previous period financial statements? You can change because it is a hyperinflationary economic situation. And if the presentation currency is of not a hyperinflationary economy, that is, it belongs to a normal economy, then in that case, for the first year, take the first year rate, whatever you have presented in the previous period, use that. In the second year, take the second year's rate. So, when I mentioned that if both the currencies are currencies of hyperinflationary economy, then assets, liabilities, income, expenses, everything will be translated using the closing rate at the end of the reporting period. So, even the comparative will be translated using the closing rate at the end of the reporting period. Okay. Now, this aspect I will not get into too much of detail because Ind AS 29 is anyways not a part of your syllabus, and even if questions are asked, it would be just to test your basic concepts. Nothing complicated is expected from this aspect. Now, coming to the last leg of the standard, the concluding part, which is the disclosure requirement. Friends, the disclosure requirements are pretty simple and straightforward. Basically, what it says is, how much profit have you recognized on foreign exchange differences or foreign exchange transaction? Disclose it separately. How much of gain or loss has been accumulated in OCI when you translate a foreign operation? Disclose that separately. If the functional currency is different from the presentation currency, disclose that, right? Then, when the presentation currency is different from the functional currency, the financial statements will comply with Ind AS only if all the translation related requirements of this Ind AS are complied with. And sometimes what may happen is the entity may present the Ind AS as per the presentation currency and as per the functional currency in both the currencies. Then you have to make a clear disclosure about what is what. Okay, what is the functional currency, what is the presentation currency, what is complying with Ind AS, what is not complying with Ind AS, and all of that, right? So let us run through these disclosure requirements quickly and understand what all should be disclosed in the financial statements, right? So coming to the disclosures, the first is amount of exchange differences recognized in P&L. So you will see a separate line item when you do your audit and all, you will see foreign exchange gain or loss. So that has to be disclosed. Then in these exchange differences, you will not disclose those arising on financial instruments measured at fair value through P&L in accordance with Ind AS 109. So whatever is covered under Ind AS 109, if there is an exchange difference for that and you are routing that through and you are routing that as fair value through P&L, that will not be included as a part of Ind AS 21 disclosures. That is the headache of Ind AS 109. Go to Ind AS 109 and understand that. Okay, so what you need to remember, exchange differences recognized in P&L except on financial instruments which are categorized as fair value through P&L. Then net exchange differences recognized in other comprehensive income and accumulated in a separate component of equity. How much of exchange differences has been captured in OCI? Now, what all exchange differences would come in OCI? Your foreign currency translation reserve. If there is a non-monetary item like property, plant and equipment and you are revaluing those items, then in that case also there will be an impact in the OCI. So, that has to be disclosed and you have to prepare a reconciliation, opening balance, movements, and disposals and closing balance. Then, when the presentation currency is different from the functional currency, the fact shall be disclosed or the fact shall be stated together with the disclosure of the functional currency and the reason for using a different presentation currency. An example could be an Indian company, say Infosys, presentation INR, functional example USD. Okay, so in that case you have to state this fact that okay, our functional currency is USD, presentation currency is INR. What is the reason for this difference and why we have done that? Okay. Then, in case of a change in functional currency of either the reporting entity or a significant foreign operation, you have to disclose the fact, the reason and the date. So, if there is a change in the functional currency of the entity, that I have changed the currency, or of the branch has changed the currency, then state that functional currency has changed, why have you changed it and the date of change. Why is it important? In the last year, you were showing the financial statements as functional currency USD converted to INR. This year, you are saying GBP to INR. How will I compare both of these? How will I know the impact or how will I get to know that there is a change in the functional currency? I have invested in the company thinking that it is US operations. Now, you are suddenly saying it is UK operations. So, it becomes slightly challenging. So, for that reason, you have to disclose this fact. Then, if presentation currency is different from functional currency, the financial statements can be described as complying with Ind AS only if all Ind AS including the translation method of this standard is complied with. So, this I have already told you, if the presentation currency is different and we have to state that the financial statements are complying with Ind AS, then the translation procedures given by Ind AS 21 should also be complied with. Then, if the entity prepares and presents some supplementary financial information in a currency other than the functional or presentation currency. So, it is not even the functional currency, it is not even the presentation currency, but they are giving supplementary financial information. Now, this happens in cases where there are, MNCs and the stakeholders are globally present. Okay, say for example, just for argument's sake, Infosys is based out of India. Assume functional currency is INR, the reporting currency is also INR, but it has a lot of transactions in the US, lot of customers based in the US. It needs to prepare financial statements in the USD because it is a US listed entity, right? Now, say for example, in the annual report, Infosys has presented INR financial statements and they have given supplementary USD financial statements. Now, when they are giving supplementary USD financial statements, that may be complying with Ind AS or that may be complying with US GAAP. Either of the scenario is possible. So, what the standard says is, if you are presenting the financial statement or the supplementary financial information in a currency other than its functional or presentation currency. So, USD is neither the functional currency nor the presentation currency. In that case, the information should be clearly identified as supplementary to distinguish it from the information that complies with Ind AS. The remaining financial statement in INR complies with Ind AS. This supplementary information is not based on Ind AS. That fact has to be stated. Then, the currency in which the supplementary information is displayed should be disclosed. That is obvious. And the entity's functional currency and the method of translation used to determine the supplementary information should be disclosed. So, if you are giving some supplementary information, the additional disclosures are also required. As I told you, pretty simple and straightforward disclosures, not complicated like Ind AS 116 or Ind AS 115 or Ind AS 19, pretty simple and straightforward. So, now before we conclude, let us have a look at to what all transaction does Ind AS 21 apply and to what all transaction does Ind AS 21 not apply. Okay. In most of the standards, I do these scope and exclusions towards the end because unless you understand the crux of the standard, you will not be able to relate what is scope and what is outside the scope. So, as far as applicability is concerned or as far as the inclusion is concerned, this standard you would have understood will apply to your foreign exchange transactions, foreign exchange balances, except those which are covered under Ind AS 109. If something is covered under Ind AS 109, for example derivatives, then that will not be covered under Ind AS 21. So, Ind AS 21 will apply to all foreign exchange transactions and balances except derivative transactions which are covered by Ind AS 109. That is the first thing. Second, you will apply Ind AS 21 for translating the financial statements of foreign operation when you are incorporating them in the financial statements of the entity. So, when there is a foreign operation, say a branch or a subsidiary, then when you have to incorporate those financial statements in the reporting entity's financial statements, you will use Ind AS 21, you will apply the principles of Ind AS 21 and translate those financial statements. So, basically you will translate the statement of financial position or the balance sheet and the results, that is the P&L of the foreign operation. And third case where the standard applies is when the entity's functional currency is different from the presentation currency. So, if the functional currency is different from the presentation currency and when you have to translate the financial statements from functional currency to the presentation currency, you will apply this standard. Let's now have a look at the exclusions from the scope of Ind AS 21. The first one is hedge accounting for foreign currency items, including the hedging of net investment in foreign operation, which is covered under Ind AS 109 hedge accounting. So, if there is hedge accounting, why will we have a hedge accounting if we have an investment in foreign operation? Say for example, there is a company Amazon US and we have Amazon India. Amazon US has invested some amount in Amazon India, say $1 lakh. Okay. Now, Amazon US has invested $1 lakh in Amazon India, which will be converted into Amazon India and the operations will be carried out. Now, at a future date, if Amazon US wants its money back, then because of INR depreciation, Amazon US may get lesser dollars back. So, for that purpose, what Amazon US can do is, if they have invested say for example $1 lakh, then they can use hedging. They may take appropriate hedges to safeguard their investment in Indian entity. So, basically the risk associated with currency fluctuations that can be avoided if they take proper hedging position. Now, that hedge accounting part is covered under Ind AS 109 and not under Ind AS 21. Then the second exclusion is when we have to present cash flows arising out of foreign currency transactions or foreign exchange transactions, then Ind AS 21 will not apply, but Ind AS 7 that deals with cash flow statement, that would apply. And lastly, if an entity has chosen an exemption under paragraph 46A of accounting standard 11, which deals with your long-term monetary items, then and while transitioning into Ind AS, they want to continue that exemption, meaning to say under AS 11 we had chosen that exemption, we want to continue that exemption under Ind AS 21, right? Now, Ind AS 21 does not provide for this. This exemption carry forward is given by Ind AS 101, right? First time adoption of Ind AS, that gives us the eligibility to carry forward the exemption. So, if that is done, then for those items Ind AS 21 will not be applicable. It is something like you have written an examination in the old course, you got an exemption, you want to carry forward that into the new course. Okay. So, when that exemption is carried forward, Ind AS 21 is not applicable. So, just to give you a perspective, if there is a long-term monetary item, let us say there is a long-term loan which is in relation to acquisition of a fixed asset, one option is to take the exchange gain or loss to the P&L. The second option is to adjust the cost of that asset with the gain or loss. Now, first option is same under AS 11 and Ind AS 21. The second option, which is given as an option under paragraph 46A, if the entity has chosen that, then and if they want to continue to use that option, then in that case Ind AS 21 will not be applicable for those specific items. For other items, Ind AS 21 will be applicable. For those specific items, Ind AS 21 will not be applicable. Let's now quickly have a look at the differences between AS 11 and Ind AS 21. Okay. The overall result may not be significantly different if you apply AS 11 versus Ind AS 21, but the process, the terms used are pretty different. Okay. Now, the fundamental point of difference arises from the usage of a new term called the functional currency. So, if you have to see AS 11 and Ind AS 21, AS 11 says foreign currency or foreign currency is a currency other than reporting currency. Okay. Any currency other than reporting currency is a foreign currency. Whereas under Ind AS 21, we have this concept called functional currency. Then we have a concept called foreign currency. Foreign currency is a currency other than the functional currency, and then we have reporting currency. Okay. So, it may be possible that the functional currency is different and the reporting currency is different under Ind AS 21. Okay. So, this is the fundamental difference where Ind AS 21 uses this term or uses this concept called functional currency. Now, because it uses the functional currency to record all the transactions, there may be a requirement to translate financial statements from functional currency to reporting currency. Whereas under AS 11, you will report the transactions in the reporting currency only. There is no question of translation between the functional currency and the reporting currency under AS 11. That is the first difference. Then, under AS 11, we have, whenever we have foreign operations, we have the concept of integral foreign operation and non-integral foreign operation. Okay. And for each of these operations, the translation principles are different. For integral foreign operation, it is like an extended entity. So, you will convert the transactions or you will translate the transactions or the financial statements of integral foreign operation thinking that the enterprise itself has entered into those transactions. Whereas, for NIFO, there is a separate approach to translate the financial statements. When you come to Ind AS 21, you don't look at IFO or NIFO, you just look at what is the functional currency of the entity and what is the foreign currency. Okay. Now, if the foreign operation has a foreign currency, you apply the translation principles and convert everything into the functional currency. Now, the result of this will be similar to what we get under NIFO. The result of this will be something similar to what we get in NIFO. Now, don't get confused between NIFO under AS 11, which is non-integral foreign operation, and NIFO under Ind AS 21, what I refer to net investment in foreign operation. Okay. So, don't mix up these two terms. The thing that you need to understand is, whenever there is a foreign operation and you will have a different presentation currency or the functional currency of the foreign operation, that you will have to convert to the functional currency. Okay, that translation has to be done. If the foreign operation has a functional currency which is same as the functional currency of the entity, then there is no need for translation. So, translation approaches are different under AS 11 and Ind AS 21. Then, AS 11 gave some exemptions under paragraph 46A, that is to do with long term monetary items. Okay. You can take it to P&L or you can adjust it against the asset, right. This exemption is given as a part of paragraph 46A. Now, similar exemptions is not available under Ind AS 21. Ind AS 21 does not provide those exemptions. But sir, you told that such exemption can be continued, that is given by Ind AS 101. Okay. So, under Ind AS 101, you can take that exemption, that is, you have taken that exemption under paragraph 46A, under AS 11, you can continue with that exemption as per Ind AS 101, not under Ind AS 21. Now, as far as Ind AS 21 is concerned, they exclude items which are covered by 109. Whatever is covered under 109 is excluded under Ind AS 21, but AS 11 does not have any such mention. We do not have an equivalent standard for financial instruments under the earlier GAAP, or that is the accounting standard. So, AS 11 does not have any such specific mention. But net if I have to tell you, whichever approach, whichever standard you follow, the overall approach, overall treatment and overall result would be similar. The nomenclatures may be different, but overall results would be similar. Let us now quickly summarize whatever we have learned in Ind AS 21. This summary will help you to remember key concepts for the examination, and that is the crux of the standard. Now, coming to Ind AS 21, it deals with effect of changes in foreign exchange rates. Now, when we started the standard, we said that there is a concept called functional currency and there is a concept called foreign currency. Functional currency is the currency of the primary economic environment in which the entity operates. foreign currency is a currency other than the functional currency, and in some cases the functional currency can be different from the reporting currency, and reporting currency is the currency in which the entity is required to prepare its financial statements. Now coming to the accounting aspects, the first principle and the overriding principle is that all the transactions must be recorded in functional currency. They need not be recorded in reporting currency or foreign currency, they have to be recorded in functional currency. So what if the reporting currency is different? Then you have to translate the financial statements from functional currency to the reporting currency. Okay. So all the transactions will be recorded in functional currency. Now coming to foreign currency transaction. If there is a transaction which is denominated in foreign currency or will be settled in a foreign currency, then the entity has to convert those foreign currency amounts to amounts in functional currency. Whatever is the transaction amount in foreign currency, that has to be converted to functional currency and recorded, right? That is the initial recognition part. Then subsequently, either at the end of the reporting period or at the time of settlement, the entity needs to measure the foreign currency items. Okay, now the items can be monetary items or non-monetary items. If they are monetary items, the remeasurement will happen using the closing rate, and any exchange difference will be taken to the P&L. If they are non-monetary items, the non-monetary items, if they are measured using historical rate, you will continue to use the historical exchange rate. If they are measured using the fair value approach, then in that case, you will take the exchange rate of the date on which the fair value was determined. Now, monetary items, foreign exchange gain or loss will be taken to P&L. And coming to non-monetary items, the exchange difference will be determined by where the original item will have an impact. If the original item gain or loss will have an impact in the P&L, then the exchange difference will also be taken to P&L. If the item will have an impact in the OCI, the exchange difference will also be taken to OCI, right? That is the broad principle of treatment of monetary items and non-monetary items. There is a slight difference in treatment of monetary items which form part of net investment in foreign operation, that I will be discussing separately. Okay. Now the first principle is for foreign currency transaction. Then we spoke about foreign currency translation. Now as far as foreign currency translation is concerned, that is translating the financial statements from one currency to another currency. Now this could be a case where it is being translated from the functional currency to the presentation currency, or it may be translated from the currency of a foreign operation to the functional currency. It could be anything. There is a translation from one currency to another currency. Now, whenever there is a translation, the principle is assets and liabilities will be valued using the closing rate, and P&L items will be valued using the rate on date of transaction or an average rate. Any difference arising because of this translation will be accumulated in OCI as a part of foreign currency translation reserve. Now, if there are monetary items which form part of net investment in foreign operation, then the exchange differences arising out of them will not be taken to P&L. They will also be accumulated under foreign currency translation reserve under OCI, right? So that is a different treatment if when it comes to monetary items forming part of net investment in foreign operation. Some example could be a long-term loan given for which the payment is not expected back. Then in that case, though it is a monetary item, it is treated as a part of net investment in foreign operation, and if there is a gain or a loss on that item, that will be accumulated in OCI and not to the P&L. Now another thing that you need to keep in mind is whenever there is a foreign operation and we are translating the financial statements of foreign operation into our functional currency, then in that case whatever is the exchange difference on translation, what do? We accumulate them as a part of OCI, right? Now this OCI balance has to be carried on till the time we dispose the foreign operation. At the time of disposal of the foreign operation, that is when you transfer this OCI balance to the P&L, right? And also remember that in the case of a subsidiary, you will have to check whether there is a disposal without losing control or whether there is a disposal and the control is lost. If there is a disposal and control is lost, entire amount is transferred to the P&L. If there is a disposal but control is not lost, then from OCI you transfer the proportionate balance to NCI, right? Now how much proportion is to be transferred, what is the share all of these details would be given to you in the question. Okay, you don't need to break your head into calculating all of that. And if you have understood the concepts in this standard, the numericals or the questions that would be asked in the examination, they would be pretty straightforward. You know the logic, you just need to calculate the amount and present the answer. That is what is expected out of this particular standard. And few things that you have to be careful about is when you account for a foreign exchange transaction, you have to take the date of the transaction, and on that date, what is the exchange rate? That exchange rate has to be used to record the transaction. Transaction will always be recorded in functional currency. At the year end, you will restate the foreign currency items, monetary using the closing rate, non-monetary using the historical rate. So basically, for non-monetary, there is no restatement unless there is a fair valuation done. Then we also understood that functional currency can be changed if there is a change in the underlying conditions, events, etc. And whenever there is a change in the functional currency, you will apply for the change prospectively. Okay, so that is about Ind AS 21. In the summary, we have covered the broader points. Just be careful while reading the question, which one is the functional currency, which one is the presentation currency. Don't assume just that, because it is USD, it has to be a foreign currency, nothing like that. It can be a US company whose functional currency is USD, and there could be INR, which becomes a foreign currency for that particular reporting entity. So with this, we conclude Ind AS 21. Let's move on to the next standard.